When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade, and as always, I'm just here to ask the questions. But of course, the words of wisdom and solid advice come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, Happy New Year. How you feeling?
I'm feeling great. Happy New Year to you. I'm looking forward to seeing what this new year brings. It's going to be an exciting one, I think.
Yeah, we've got a lot of great shows lined up for our listeners. We're going to take a look back at what happened in 2023, but very optimistic about 2024. Are you optimistic about how things are going to shake out here for 2024 in the market and in the economy and all that? I know you don't have a crystal ball that necessarily works, but how are you feeling about what's poised to happen in 2024 so far?
You know, I'm not on the camp that, hey, we avoided a recession, we're done, we're out. You know, it's all full guns a-blazing ahead. I think we're probably going to have as much or more turmoil in the markets coming ahead of us than we've had in a long time. We've got the election cycle. That's one thing that, you know, sort of plays out with some similarities, but then again, we haven't had election cycles with this much heated opposition, division in the electorate, the people trying to keep people off the ballot, basically, you know, claiming that the one side's trying to ruin democracy, so they're not putting him on the ballot. Like, that's ridiculous. It's like, you know, cat calling kettle black. I mean, that's like the most hypocrisy I've ever seen. There's a lot of things that I think may change the typical election cycle if it doesn't play out. But again, I think because last year, the only thing that really saved us, I think, from the recession that is typical, and I'm not saying we're out of the woods yet, even though the market seems to think we are, is that we had this AI hype. I think the AI hype really got a lot of people excited about something, kind of a bright spot to look forward to and to latch onto. It made super overvalued stocks become even monstrously overvalued now, continually become overvalued. And, you know, people saying, yeah, but with all the AI money they'll make, well, we don't know that yet. You know, the forward-looking earnings is still in line with what we should overpay for a stock now. And that didn't make a lot of sense, but it gave people hope. And the fact is that there was most of the year last year, there was still a ton of excess savings that people were putting in, the excess money that Biden administration and even the administrations before that, we can blame some of that on Trump too, during the pandemic and things like that. We printed money. We had all these bailout programs where money was just given to everybody so that they could stimulate the economy. And although we couldn't go out and stimulate the economy that much, most people just fixed their houses, built homes, or, you know, construction did really well. The other things that did really well was tech, because everybody's working out of their houses. They're spending more time, you know, in their phones doing stuff. And, you know, technology did really well. Then the AI is just on the tails of that, you know, got us crazy. But, you know, the other thing that you look at is just all that extra money laying around. What you can't spend it all. You can spend some of it, but most of it just ended up going back into the market. That extra money supply, which has been decreasing as interest rates have been increasingly growing, as the Fed's been raising the interest rates, it kind of took some of that money, that excess money, out of the economy to where we finally got back down to where there's not a lot of people just spending money to spend money. But then again, we also saw that investors didn't just spend the excess money, the excess savings in the market. Many regular people, middle-class people, most of the people listening to this show, most of the people in the nation, basically the bread and butter of America, the heart and soul of America, regular people with regular jobs, not business owners, hedge fund managers, and people in the government that, you know, can insider trade, but people that actually had to go and spend money on stuff to live, is we're noticing that typically people in the past have either cut back, not spent, or whatever, but people have used their savings to live. Because of the inflation, they have spent down a lot of that savings. So there's a lot of interesting things. I mean, we've seen debt on credit cards go up because people don't want to wait to buy things. Hey, that stimulates the economy a little bit, and that's good. It's actually helped us maybe avert or push down or kick the can down the road on this recession. But now we're seeing the defaults. We're seeing over $1 trillion in debt. We're seeing defaults. We're seeing car repos at unprecedented levels. We're seeing actually starting to see some deflationary pressures, meaning that there's not enough excess cash to buy stuff. We're seeing some costs go down. We've also seen a lot of the local producers of oil actually get back back into the action, so where our energy costs are down. And so, there is the optimism that interest rates don't have to continue to go up. The Fed said that they're not going to raise the interest rates anymore. They might even lower them next year. And, that was obviously another big deal to the market. Everybody got excited. Hey, we're done. The inflation is fixed. Well, is inflation really fixed? First of all, I don't trust all the numbers we get out of Wall Street or Washington. I think they're manipulative in a big way. So I think maybe we're being told that inflation isn't really as bad as it is. I think the cost of gas going down is going to help that. But the inflation rate doesn't just automatically go to 2 and stay there, especially if the government's going to be more accommodating on interest and lowering interest rates next year like they say they will. So there's 2 things that I can foresee as reasons that the interest rates go down. And the biggest one is some recessionary pressures take place. Big market sell-off after this big run-up we had this last couple of months especially, which was underscored by the hope that interest rates would go down and the hope that inflation is now in control. But for the Fed to actually lower interest rates, it seems to me that we would be going through some sort of a recessionary time where you had to loosen monetary policy in order to create more assets or more money supply in order for people to either pay their bills or to buy stuff, or maybe it's just kind of a play to prop the market up so that the election goes the way the Fed wants it to do or the way that they're manipulated into telling us it should go. So I still think there's a lot of unknowns in the future. I think if are those budget cuts, they come on the tail of some recessionary pressures that I still think can happen. Now, I've already always said this, how many times on the radio, is, all these cycles, these, decreasing economic indicators that, went down 16, 17 months in a row. Every time they go down more than 12, we end up in a recession. Anytime you have the inversion yield, the yield curve invert, it always ends up ending in a recession. And typically, more often than not, these happen within the 6 to 18 month range. Kind of the 11 to 14 month is kind of the sweet spot, but the 6 to 18 month is where, the bell curve of probability happens. But outside of that, it's generally, there are some that extend out to the 24 month or so. So I don't think we're out of the woods yet. I also think that we have enough room because the inversion of the yield curve was so extreme. It's going to take a little bit more work to get it back to where long-term bonds pay more interest than the short-term bonds, meaning it might be the fact that the yield curve uninverts because the Fed actually makes it uninvert. Well, historically, every time it uninverts, there's a recession. Now, I don't know if that's going to be Fed-induced. I don't know if the Fed's going to save it. But I will end this too long comment, like usual, with a statement that I've heard all too many times. And after 30 plus years of being in this business, I realized that these 4 words are the most dangerous words. And John Templeton was the one that made them famous. This time it's different, or it's different this time. You can put it whatever order you want, but it never seems to end up being different. The only thing different is what's the hype that we can throw out there to kick the can down the road, stretch the rubber band even farther so when the market does eventually correct and get back to where we call equilibrium or fair value. Bottom line is what's going to get it back to that fair value that always ends up becoming the norm. I mean, there is a normal kind of fair value range that the market always ends up getting back to. And we're so far beyond that, especially on the big cap stocks, especially the Magnificent Seven stocks, which, we saw just early this week, a nice little sell-off. Well, if you know how the market works, everybody gets bonuses based on calendar year returns. And they milk the profits and hype the market to a T. Now, if they think the market's going to be kind of flat or even down this year, then there's really no incentive to try to hype the market for a whole year when it's not going to work anyway. Well, maybe now's a great time to take profits after that big run up. So I think the smart money's going to do that. I do think there are some bright spots out there as far as investment opportunities. If the Fed's going to lower interest rates, I think bonds will still be a good play again as a hedge because bond prices actually increase when interest rates go down. A lot of that's already factored in. But there's also some undervalued or fairly valued sectors in the market, the micro caps, the small caps, the values, the dividend stocks. They've been forgotten for the last year on this market rebound. It's been all NASDAQ stuff, up 45%. And by the way, it didn't go down 45% in 2022, but it went up 45% in 2023, and we're still 5 to 10% away from its top. Remember, you have to take more steps forward to get back to even than you do on the downswing. So we're still kind of fighting out of that on the tech side. I don't know that we'll hit those 2-year highs that we had about 2 years ago for a while. I think we're going to have a choppy market. I think if you're going to look for stock plays, you look for those undervalued or fairly valued sectors. in those, kind of forgotten areas. And I think we're already seeing smart money flow more towards, those sectors of the market, the dividends, the values, the Russell 2000, the small caps, micro caps, and the emerging markets even.
We're talking with Jeff Vogan of Premier Retirement Planning and Wealth Management, and we're talking about some forecast for 2024. Jeff, when analysts were asked about 2024 and their forecast, politics and geopolitics came up a lot in these discussions. Investing professionals cited Taiwan's upcoming presidential election, another looming federal debt ceiling showdown in the U.S., beginning of the 2024 Republican presidential campaign, and the ongoing conflicts in Gaza and Ukraine as more than potential threats to the market calm. How do you feel about the politics and the geopolitical scene in this country affecting the markets here in 2024? It's got to have some sort of an effect.
Generally, it does. It has. There was a nice sell-off when the Ukraine conflict broke out with Russia, and it was short-lived. I think the market has become incredibly resilient, and I think it's as more and more private households, or what we call, and I don't mean this disparagingly at all, is the dumb money that doesn't understand inflations and cycles and a lot of things like that, are just buying stocks, and they've learned that, man, as long as if something bad happens, the government just prints money, there's more. So let's just keep on throwing it at the market. And it's been working. The market has become very resilient as more and more people just, forget about fundamentals and forget about how devastating a correction can be. Short memories, I guess, even with the downturn in COVID, which rebounded right away. We had a rebound in 2022. It seems for some people it rebounded, but really just those big high-tech stocks that got beat up really saw the rebound. Most people that I look at portfolios that have been elsewhere and just rode the market down and rode it back up aren't anywhere close to break even, because on a diversified portfolio, you've got most stocks either holding even, actually creating more new lows, and you've got just those few stocks that have some sort of an AI story behind them that have been really cranking the indexes up, and being largely 90 to 100% of the entire index growth has been attributed to 7 stocks. I mean, that's not good breadth. It doesn't look good unless you're only investing in those. And as a financial advisor, that's kind of hard for me to only put you in 7 stocks that could go down just as fast, which, by the way, they were the biggest losers the prior year as a financial advisor. So not very many people, unless you're super aggressive and super willing to lose money, are in that position to make a lot of money during these volatile market times. But I think as we look at geopolitical events, they're going to have to come back and make some sort of an impact. I think as far as the potential escalation of stuff in Israel and Gaza, the division of people taking sides on that deal really surprises me. But it's baffling that, honestly, it's kind of baffling that it hasn't had more of an effect on the market right now, thinking that, these are all conflicts and things. Our bases and American interests are getting bombed and attacked by foreign aggressors. We're in a situation where any of those things could kind of be a tipping point into more of a world war conflict. And it seems like we're paying for the whole thing with our taxpayer money. So it really frustrates me to see, where all my tax money's going. And it seems to be creating more and more of more hotspots around the world that I believe could amount to something bigger and not just affect the markets or make people finally become scared enough or afraid enough or respectful enough of market forces and what those kind of conflicts mean to the global markets and the global effect on our investments. So I think we have to be conscious of that. I think that plus the election coming up, there's just a lot of things that I think could be tipping points for a sell-off in the market, that recession that I think is still historically in play and, may or may not happen to the levels that some people claim it will. I mean, we've got Harry Dent and some people that think the market's going to drop more than 50% before it finds its equilibrium, and we're going to go through the biggest, stock market crash that we've seen in our lifetimes. Other people are kind of hinting at that could be possible. And, that comes in the face of from 2 months ago when the market or investors were extremely pessimistic to now to an extremely optimistic or even an overly optimistic, kind of almost a greed level on the optimism and, pessimism scale. We've got people that are, just so sure the market can go nowhere but up. And it seems to be that's the majority of the loudest voices. And when that usually happens, they're typically contrarian in nature to what really ends up happening. And by the way, I would like to think that that the Fed actually acted responsibly, even with these quick interest rate hikes and with putting them on pause, and somehow the effective rate of inflation has gone down to a more tolerable level. If that's the case, well, man, good for them. It finally happened. It typically doesn't. But every time that the Fed or the powers that be, Wall Street or whoever, start stating, oh, it's just a soft landing, or, oh, well, we'll probably have something, but it's probably going to be easy. If they even acknowledge that something bad could happen and they say it's going to be easy, history shows it's usually a lot worse than that. If they say, I mean, look at 2022. I mean, it was just going to be, oh, this is just a momentary transitory inflation. We'll have a couple of interest rate hikes. We'll tame it and it'll be all back to normal. Everything's fine. Well, people believe that from about January to March or April. And then by May, I was like, whoa, this is not real. They're just lying to us. This is, bad information. We've got to, go a little bit defensive and run for cover here, or we're going to lose a lot more, which some people did. And some people got lucky and rode some of it back. But bottom line is there's a lot of uncertainty out there. And if you can't afford to risk your money, then don't. The nice part about that is that there's a reasonably good interest rates that, if inflation is in fact below 3% or heading towards that 2 mark, and we can still get 3 to 5% on bonds and CDs, then great, you're keeping ahead of inflation. That's really our long-term goal anyway, is to make our money grow as fast as inflation grows, and obviously hope we saved enough to get us through retirement. But I think geopolitical is one of those unknowns. It's that thing that could rear its ugly head at any time, and we've got to be conscious of those things that could happen. So, be careful. If you can't afford to lose money, don't put it in the market. If you just feel more comfortable being less aggressive while these conflicts resolve, while the inflation gets behind us, this might be another year to sit in more defensive positions and not worry about the roller coaster ride that most investors are probably going to go on.
Well, as far as 2024 goes, Jeff, I'm an eternal optimist. I am going to hope for the best, but of course I'm going to plan for the worst. You're listening to Premier Retirement with Jeff Ogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and also up in Mesa. And in just a moment, Jeff, we're going to be talking about your case of the week. But in the meantime, I want to invite our listeners to give you a call here. Get 2024 off to the right start by requesting your no-cost, no-obligation Premier Retirement Roadmap with Jeff Ogan. Just a chance for you to sit down with Jeff, have a friendly conversation, a discovery process, if you will, about where you are, where you're situated right now, and how you're going to get through 2024 and beyond. Again, it's not going to cost you a dime. That number to call, 520-780-9059. You can do it this weekend if you want. Leave your information. Shelley will give you a call back on Monday and set up that appointment with Jeff there at Premier Retirement. Once again, that number, 520-780-9059. Why wouldn't you want to get in sooner than later while you've still got most of the year left to make some changes if needed? Again, it's not going to cost you anything, but it could be the most important call that you'll make all year. 520-780-9059. Make that call today. You can also request your retirement roadmap online at premret.com, premret.com. Jeff, every week we talk about Case of the Week here in the radio program, and it doesn't have to be unique. A lot of people come in and they have the same sort of problem, so I'm going to leave it that way. Jeff, let's talk about the Case of the Week, and basically it could be the case of the past couple of weeks or maybe the case of the year.
Well, actually, the last couple of weeks we've been just doing year-end stuff, taking a little bit of time off for the holidays and haven't seen any new clients. But this is a typical thing. I just want to kind of reiterate and capsulize what the process is. And the cases of the week really come down to this, is what do you want your money to do for you? This year, especially, we had a lot of people come in that were a little bit shell-shocked and rocked from the prior year of losses. They either went conservative and now they're in bonds, which are going up and down, or trying to wait and get them, let the market, return their investments back to, their original levels. I had a guy come in with about $500,000. He had about $500,000 a couple years ago, but he's spending $3,000 a month, which is, it's probably a little bit heavy on the withdrawal side, but of course he wants to use more of it when he's young and healthy. He's, pushing 70. And this is just, one typical example of that. And I'm going, man, I said, that's kind of a push with, if there's any more market volatility, I said, this doesn't look too good long term. I mean, Wall Street has kind of a rule of thumb of 4%. And it's been actually tweaked down because of, low interest rates and because of the extreme volatility we've had in the last couple of decades with 50% market crashes and, interest rates going all over the place and the Fed kind of, tweaking things. Has not been an easy way to figure out how much you can legitimately take out of an investment without running out of money. So if you want income, if this is all about income, and for his case it was all about, I need income. I don't really have a bad tax problem, but I saved a decent amount of money so that I could supplement my Social Security and live okay. I mean, this particular guy I'm thinking about in my head is a single dude, but turned out of the 500, he'd kind of drawn it down to about 400. Turned out that, if we could make a tax efficient income stream, that he really didn't need the $3,000, he could live on about $2,500, a little bit less. and still have $100,000 in the market that he could play with and have about $300,000 in the market that, or not in the market, but in an income producing asset that in just 1 year would give him more than an 8%, I think it was closer to 8.5% rate of return guaranteed on that 300 plus that he had put away. So if you can get a majority of your income from something that's guaranteed and not worry about the other, then you use the other just for, the what if money. So I guess the peace of mind was what settled in on him, is like, oh, I don't have to risk my money and risk another downturn to eat up another $100,000. I mean, if I live another 20 years and have 3 or 4 more of these downturns, I'm out of money before I can afford to be out of money. These index annuities that we use that have principal protection, guaranteed income riders, meaning guaranteed income for life, you still have access to the principal of that account should you need it, or should you just want to bail out of the income plan and just use it or cash it in, you can. I wouldn't do that though, because if for some reason the markets don't perform and that asset runs out of money, you can still get a paycheck while you're still breathing. That $2,500 or so, or whatever it was that we ended up coming up with, ended up being available to him forever, even if the account underperforms. Now, historically, it doesn't underperform, and historically, it kind of keeps up with that payout. So rather than drawing down principal plus interest every time the market gets volatile, like he was doing for the first 10 years of his retirement, he doesn't have to do that anymore. He's got more of a peace of mind knowing that he's got his bills paid. He doesn't have to, save extra for a rainy day and then maybe not take some money out. And then he's still got his play money. He's still got something that has some upside, and the rainy day money, not to mention the money that he had in the bank as well. So again, money can serve different purposes. Most people want to turn assets either partially into an income stream to supplement Social Security and pensions. If you've got a lot of Social Security and pensions, or if you're married and your spouse has a pretty good income as well, and you're in a high income tax bracket, maybe you want to convert some of these assets into a tax-free income stream, which is like a principal protected insurance product, insured, secured, and principal protected, and generates tax-free income and gives you long-term care insurance, a death benefit if you die prematurely for your spouse to, live on that extra income should he or she need it, and some other benefits. So there's income, there's growth, there's legacy income, there's tax-preferred assets, maybe estate planning assets. There's 5 or 6 different ways that you can position an asset to serve you. But remember, money should serve you. You should not serve money. And if you have to always be there watching your money and making hard decisions that basically take years or time off your life, or at least reduces the quality of your life because of your worry and stress, then in my opinion, your money is not serving you. It needs to create that peace of mind. It needs to pay your bills. It needs to save you as much taxes as it can. Whatever's left needs to go to your heirs how you want, with the least amount of trouble, taxes, and problems. And this needs to be your plan. That's what we do with the Road to Retirement. Our roadmap, our retirement roadmap, our Premier Retirement Roadmap is all about what do you want your money to do for you? How can it serve you? And let's set it up that way and let it serve you, so you have the peace of mind to carry on your retirement, which is live that retirement you planned on, rather than retirement that's dictated to you by markets and things you can't control.
And you talked about that retirement roadmap, Jeff, and I want to point that out, that it is a 5-point retirement review. When you come in and sit down with Jeff, it's going to take about 60 minutes or so. He'll cover an income plan with you, investments to support your income plan. Also, he's not going to neglect the tax plan. That's very, very important. It also involves a health care plan to pay for health care costs, long-term care, and also an estate plan. It is a comprehensive plan, and it is yours for the asking. All you've got to do is call 520-780-9059 and say, I want my Premier Retirement Roadmap. You don't even need to say that. Call 520-780-9059 this weekend. Leave your information. That means your name and your telephone number. Shelley will give you a call back on Monday, ask a couple of quick questions for you, and that'll give you the chance to come in and sit down with Jeff on a one-on-one basis and ask your questions and get the answers that you need to put you on a prosperous path towards retirement. Once again, no cost for this. There is no obligation, no judgment. Get 2024 off to the right start by making that call today. 520-780-9059. We do have some slots available for you sooner than later, and it's not going to cost you a dime. 520-780-9059 or online at premret.com, premret.com. You're listening to Premier Retirement with Jeff Hogan. If you missed any part of the program, remember we're also a podcast. Just go to wherever you get your podcasts, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your wealth and your journey towards a successful retirement. Time for a break, Jeff. When we come back, we've got listener questions and more when our show continues right here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Happy New Year. Thank you so much for joining us here for Premier Retirement with Jeff Hogan. We're here for you every week for your fiscal fitness, your financial education. And a reminder, we're on for you multiple times on this weekend. Saturdays at 7 a.m. Also, we're on at 9 a.m. and 1 p.m. And then on Sundays at 11 a.m. So you've got 4 chances to hear us on the radio. And remember, you can hear us 24 hours a day anytime you want on your time frame by going to our podcast and asking for Jeff Hogan at Premier Retirement. You'll find that wherever good podcasts are heard. Again, our telephone number 520-780-9059. Our website, premret.com, if you want to find out more about the firm. In this part of the program, we do listener questions. We'll kick it off with David, who's listening to us in Tucson. And David writes, I'm a 63-year-old man with $46,000 in a 401k. I don't have a lot of faith in the stock market anymore, even though it's gone up lately. I would like to know if moving most of it to a gold and silver IRA would be a smarter way to keep what little I have.
Well, there's a lot of gimmicky stuff out there about a gold and silver IRA and stuff like that, where they actually support it with the actual bullion and stuff like that. And honestly, I don't trust it. I've had clients that have ended up having to sue for their money, or they had to, by the time they actually sold the bullion, there was so much commission coming in and going out that they lost 20%, 10 buying and 10 selling. So it didn't really make a lot of sense. If you look at gold prices over the last 40 or 50 years, I mean, the average rate of return is like 2% a year. If you realize that gold's, at 2,200-ish or something, it's over 2,000 an ounce right now. It's kind of made a new high. It's made actually kind of a triple new highs and higher lows and higher highs. It looks like it's actually turned positive. But if you look at gold over the last 10 years or so, I mean, gold's been down almost 50% where it is. I mean, what if it goes back to that level? What if it goes back to where it was just a year and a half ago? I mean, you're still looking at about a 20 to 25% decrease in value. So there's nothing that's not volatile about gold. And just because you can't lose the gold, or you have to lose, if you want to sell it for value, you're going to lose because you have to pay a commission just to broker that gold. So if you like the idea of having gold as a hedge, because right now it actually does look like it's on an uptrend, and it's actually in a confirmed uptrend. If you look at trend analysis and you look at fundamentals, it looks like a good buy right now, but it's also when you probably want to get out of really quick without having to take a 10% sale just to, sell the bullion, if that's the type of gold IRA you're talking about. Here's the best way I would do gold in an IRA or a 401k. You probably have to move your $46,000 from your 401k to an IRA, and you probably can do that because you're 63, and that means you're over 59 and a half, where you have access to maneuver with your 401k, I'm assuming, depending on your company. Sometimes there's a restriction, but generally speaking, there isn't. So you can form your own IRA and then go buy an ETF, an exchange-traded fund that has gold. My favorite one is iShares Gold. It's IAU or IAUM. Those are the two that we use. I believe IAU might be more for the retail side, and IUM, which is what I use on the more institutional. But IAU, it's iShares Gold Trust. It's basically correlates with the spot price of gold. And there is no commission going in and out of it. They're not buying and selling gold with commissions and making money by selling you a gimmicky item. They're actually putting it in gold assets. But the other thing is, I wouldn't put all of it in gold. I don't know what other money you have. I mean, if you've got a few $100,000 in other stuff that's in stocks and bonds and things, CDs that are safe, I wouldn't risk all $46,000 if that's the sum total of your savings in anything, especially gold. Maybe you put 5 or 10% of it. Maybe you put 5 or 10,000 max into something like a gold asset. Or again, it depends how conservative you are. Your question kind of has a tone of that this is kind of like the last little bit you want to hang on to and you don't want to risk it. Well, I wouldn't. Gold is risky. Gold goes up and down. And gold has commissions getting in and out of it. If you're buying those gimmicky things like you see on TV, buy gold, buy gold. If gold was such a great asset, why aren't they keeping it? If it's just going to go up through the moon, why aren't they keeping it? They're just getting paid by the people that broker gold. That's all. So bottom line is, be careful about getting too much into one asset. Be careful as just assuming gold is a safe play. Even if you have a little bit of bullion in your safe at home, maybe it is for a day or two when the banks aren't open and everybody only wants to trade food for gold or bullets or something like that. It might be good that you have a little bit of those things. But I don't like it as a all-in investment at all. I like it as a hedge for a portion of your portfolio as kind of a maximum exposure. And of course, right now it's decent, but it doesn't always have to hold up that way. Diversify into a more broad spectrum of investments that have some safety, maybe some principal protection, or maybe some short-term bonds right now, or at least will hold their own until we see what shakes out with this election year, which is always kind of a topsy-turvy potential, and also the all the stuff that's happening overseas geopolitically. There's just some stuff going on where I wouldn't risk any of that $46,000 in any one asset. I wouldn't put it all in the market. I'd diversify into more safe things.
David, thanks for listening to us, and thank you for sending in that question to us at primret.com. Shelley will be sending you out your book, Retirement: The Road Ahead. Next question, Jeff, is from Diane in Rita Ranch, rather extensive, and she writes, I'm a 76-year-old widow with a mortgage of $153,000 with $73,000 in investments and $20,000 in a high-yield savings account. My Social Security and very small pensions give me a monthly income of $3,400 a month. I'm saving about $400 a month, splitting it between my bank savings, $100, and my high-yield savings account, $200, and my investments, $100. My investments are split 50% in stocks, 50% bonds. It seems like the stocks have made money, but the bonds have lost money. My investments have remained about $73,000 for the past 2 years, in spite of the $100 a month I've invested. Does the old adage still hold true that at this age, it's best to split investments 50-50 in stocks and bonds? It appears that if I'd had more in stocks, I would have made more money over the past couple of years. Given the market these days, is there a better way to diversify investments?
Well, dollar cost averaging into the market, if you were just going strictly into an index that was driven by those overvalued Magnificent Seven, I could see that adding $100 a month for the last, couple of years, which really doesn't add a ton, to be honest with you. I mean, you're looking at $2,500, and you're looking at, most stock indexes are just barely back to break even. The Dow's only 30 stocks, so you've probably got, mutual funds and some other things that have more correlation to the overall broader market than just an index with 30 stocks in it. The S&P 500 is almost back to even. The Qs or the NASDAQ, the more high-tech stocks, still have a ways to go. So it stands to reason that if you're break even, that's about all it'll do. But if you're looking at dollar cost averaging in, and of course you're 76 years old, I don't know how much longer you're going to invest. Maybe it's time to just take the risk off the table and get 4 or 5% and lock in some long-term interest rates that that'll beat what inflation should be now that they've got it under control, and hopefully it'll stay under control for the next 8 or 10 years. You can't get a 10-year CD, but you can get 5 and 10-year insurance-related annuity products that give you some liquidity that might make you closer to 6%, and locking that rate into close to 5 or 10 years, or at least over 5 for that long a period of time, might be a lot safer and easier play. You wouldn't want to add money to it, but in that case, you add money to the high yield savings, or maybe you start a new account where you dollar cost average into a little bit of investment account so that volatility isn't going to bug you or be a life-threatening event if you lost what is a big chunk of your savings. If you only got $20,000 in high yield savings, I mean, you're looking at a kind of an 80-20 plan here. And 80-20, I think at your age, I think that's way too much risk if the investments you're talking about are all stock related or market correlated. I think there's a lot of belief and a lot of evidence that lines up to believe that we're going to have kind of a roller coaster ride, choppy next 10 years. If you look at history, the valuations where they are right now, different market cycles that always end up repeating, we're looking at kind of a lost decade potential over these next 10 years, where the average rate of return is maybe somewhere between 0 and a couple of percent, kind of like the 2000 to 2010 decade that they call the lost decade. There was a crash right up front. Maybe we had that one last year. This past year was better. The year before that was bad. And maybe we'll go up for a couple of years and we'll have another crash. Maybe we'll have another crash this year. Maybe it's just going to bounce around for a while, and you're just going to be frustrated throwing money in something that goes up and down and never really accumulates. You do a lot better accumulating in a high yield savings account, or even a bond portfolio that was more short-term bonds. And as interest rates get a little bit more solidified, we're going to see the longer-term bonds actually increasing in value. You might want to invest in some of that so that you can reap those rewards when the market gets back to normal, because that's what smart money's doing right now. They're buying the fairly valued sectors of the market. They're loading up on bonds. That's why we've seen bond interest come down, is because there's been a lot of buyers of bonds lately. Even with this crazy run up in the market, all the money's not flowing into the index, the S&P and the Dow and all those NASDAQ stocks. There's a ton of money flowing into bonds. I mean, don't kid yourself. the bond market has now become a hedge again, and it might actually do you better. At least go that 50-50 split. I think that's a smart way to start. If you went, roughly 35,000 in each of those categories with that 73, that would be a good start because it would take a lot of risk off the table. That high yield savings account sounds like that's kind of your bank or your emergency quick savings, but you said you do have some bank savings. I don't know what's in there. Look at your whole picture. Don't take more risk than you can afford to lose. If you can afford to lose that 73,000 or wait 10 years for it to become better than break even, go for it. But I don't know. At your age, I wouldn't do it.
Diane, thank you so much for listening to us there in Reedy Ranch. And of course, Shelley has your book, Retirement: The Road Ahead. She's going to put that in the mail for you. Final question in this segment, Jeff, comes from Ken, who's listening to us in Oro Valley. Ken writes, I'm 60. My wife is 62. I'd like to retire at the end of this year, 2024. We're testing what it's like to live on our projected retirement income made up of military retirement, disability, federal civilian retirement, and Social Security. We have about a $500,000 balance on a 2.49% fixed mortgage. Our projected income would be comfortable if we had no mortgage payment, but it's a little tight with a monthly mortgage payment. My question is, are there any mechanisms to pay off the mortgage with tax-deferred retirement funds, 401k, federal thrift savings without taxing all the funds as income?
Well, if it's in a 401k, thrift savings, or no matter what, when you get it out of there, or even if you convert it to a Roth, you're going to pay tax. There is no mechanism, even if you're paying off your house or if you're buying gold with it or doing some sort of a trick, you have to still pay tax on it as it moves from those tax-deferred accounts to whatever it is you're going to invest in to pay off your mortgage. Now, I would not don't even think about taking $500,000 out of those deferred savings and paying off your house because not having a mortgage would be good, because that'll cost you probably somewhere in the neighborhood of $150,000 to $200,000 in taxes, and you'll end up having to pull out $700,000 or $800,000 in order to pay off that $500,000 balance with pre-tax money. So I would only use after-tax money. Now, we do have plans when we do our retirement roadmap. We do have plans where maybe over a 5-year period, you want to maximize your current tax bracket and pull a bunch of that money out of those 401ks, pay taxes on it, convert it into a LIRP. That's my favorite asset. And by the way, I don't have a problem with you having a 2.49 fixed mortgage. I think you should keep that forever and keep making money on your other stuff, especially when even the short-term bonds, even long-term bonds, there's no bond you could buy that doesn't pay at least 2.49%. So you could keep that money invested and still make more than that mortgage is, just pulling that money out even after tax. Do better just keeping the 401k. However, if you wanted to take advantage of the current tax rules, there's only a couple years left on them now that we're in 2024. 2024 and 2025, we have the Trump tax cuts. Now, unless he gets reelected, I don't think they're going to be reinstated. They're going to go away in 2026. So you're going to go back to the old pre-Trump tax rates, which are a little bit higher. So if you wanted to accelerate those withdrawals from some of your IRA money, thrift savings, 401k, and so forth, pay taxes now at maybe 22% instead of later at 25 or 28%. And put them in a LIRP, life insurance retirement plan. I love that mechanism to shelter income. And what you do is you just load that up. Maybe over the next couple of years, you're able to put $400,000 into this LIRP account. And maybe at that point, you end up taking, about $30,000 a year out of that in order to, you don't actually take it out of the LIRP. You actually borrow against the death benefits that you buy with that $400,000, which would be a bigger distribution than your mortgage, I'm guessing. Well, depending on how long you've had it, if it's only 2.49, $500,000, I'm guessing your mortgage payment was like probably less than $2,500 a month. So, what if you could take $2,500 a month out of a LIRP that you funded with that money, pay taxes on it as it comes out. Maybe you've got some savings in the bank that you can pay that tax over the next few years. And now you get to withdraw money as a loan against your future death benefit, which is tax-free, meaning you take tax-free money out. You don't have to pay any more tax on the growth. You get to pay down that mortgage if you want to, just because you don't like it. Or you can live on that money and keep that mortgage for as long as you like, because you said, without the mortgage, we'd be fine. Well, great. Now you're living on tax-free income, and you have enough to pay off that mortgage as well with tax-free income. And when you die, you have a nice little death benefit for your heirs. So there are some other ways to skin the cat, maybe seem a little bit more complicated on the surface. Obviously, I'm sitting here talking to you on the radio. I'm not writing it down or showing you a spreadsheet of how the numbers really look. But, at your age, if you're still healthy, that LIRP might be the best way to kind of money launder, and I say that in a non-illegal way,
right.
To basically legally money launder your taxable money, pay taxes now at a lower rate, and launder it into a tax-free money stream, which would more than overcome the deficit in income that you're worried about and, put you in a better tax situation for the rest of your life and pay off that mortgage over time. I mean, 2.49%, I don't know if we'll ever see that rate again.
I think so.
I kind of hope we do, but I don't think we will. I think if it gets down to 3, I think we'll be lucky. If it stays in the 4 or 5 range, I think that's more realistic. I don't think it's a bad thing for people to actually pay money to borrow money. I think it's, part of the give and the take of doing it. When you artificially manipulate interest rates down to close to 0, it creates such a boom in the way people can, borrow cheap and spend more money. It kind of overstimulates the economy and leads us to what we're in right now, an overstimulated economy where everything, including stocks, costs too much, houses cost too much. And now the middle class has a harder time to exist. The rich continue to get richer and the politicians keep playing their games. But, society as a whole, I think, suffers when the interest rates are too low, especially for those retirees that want to make 4 or 5% on their money in retirement so they can keep up with inflation without taking risk in the stock market. So I think it's a win-win for everybody to have interest rates a little bit higher than they used to be, but not so low that we go back into the same situation that we have to fix with, Fed intervention like we're doing now.
Ken, I hope that answered your question. We appreciate you listening to us in Oro Valley. And of course, we will send you out Jeff's book, Retirement: The Road Ahead. Listening to the program today and you want to be like Diane and David and Ken, get your question answered on the air, you can do it very simply by going to our website, which is premret.com, premret.com. Navigate over to the contact form, send us your question there. If we do use it on the air, of course, you will get that book and you'll get your question answered on the air. If you'd like to come in and sit down with Jeff and ask your questions in person, that is very simple to do. All you've got to do is call right now. Pick up the phone and call 520-780-9059 and request your Premier Retirement Roadmap. Just a friendly conversation between you and Jeff, one-on-one, so that you can get your questions answered about a prosperous 2024 and your roadmap to retirement. Again, it's not going to cost you a dime, but it could be the most important call that you'll make all year. So why not make it sooner or later? That number again, 520-780-9059, 520-780-9059. You can also request your retirement roadmap online at premret.com. It is premret.com. Jeff, of course, with the turn of the year, a lot of people now focus on taxes. The tax filing deadline is not until April 15th, but I want to talk about some of the filing deadlines that people need to be aware of here in the month of January and in the next couple of months. I want to start off with the first one here, which is going to be January the 10th. If you are a worker that accepts tips, you have until January 10th to report those tips to your employer. But more importantly than that, at least for small business owners like myself, you are requested to file a quarterly tax payment by around the 15th of January. Now, Jeff, I know that there's some conflicting information about doing that. Can you talk about the pros and cons of filing that quarterly tax payment January the 15th?
Well, if you really want to just have it paid, if you've got money sitting in the bank not making interest and you don't want to get dinged with a little penalty or some interest payments that the IRS is going to charge you for not making the amount of withholdings that you should have, then go ahead and pay it. And it gives you the peace of mind. Personally, I invest with interest rates. I have some personal loan investing as well as just even the annuities with fixed rates and the bonds with fixed rates pay more than what I'd lose waiting, in my opinion. So, I have access to my money. I just wait to pay taxes. That's personally. I have clients that like to do that. Not everybody, but it's really up to you. The fact is I had one time when the IRS called and I was actually disputing a charge that was a little overbilled because I had paid some and they weren't crediting me some of which I paid. So I called them and this guy on the phone says, well, you're paying your taxes illegally. I'm like, no, I'm not. Go, yeah, you're supposed to have, the law says you have to make quarterly payments. No, the law says if you don't make quarterly payments, then we're going to charge you interest when you do pay. We're still going to charge you the taxes. So right. You can't pay your taxes illegally. You pay taxes as you choose to based on the rules. So if they would change the rules and say, we're going to come take your house if you don't pay your quarterly payment, I'd be a little bit more responsible and I'd pay my taxes early. Now, I think that's, pretty rude of them to make some sort of a demand like that. I think it's even rude for them to demand that you pay taxes a year early on, some of your money from a quarterly basis that you paid some March of last year and then through January this year in order to keep up on all the taxes. And do they pay you any interest? No, but they sure ding you if you don't pay it soon. So they're basically living on, trillions of dollars of float of just the interest rates and just the power of the time value of money. And that's why they encourage you to pay early. And in my opinion, just by doing that, they actually suck more tax money out of us. In addition to the tax rate that we pay, they're actually sucking interest off of that by charging us interest by paying when the taxes are due. I think it's a total, I think it's just BS.
Okay.
And for lack of better words, I could have probably used some better expletive language for that. But it's a bunch of baloney that they have it only go one way, and somehow that they dictate it. Taxes originally were supposed to be voluntary, and of course, the more voluntary they got, and the more greedy people got, the less people wanted to pay them. But if they would just be fair and say, hey, this is what it is, I think this day and age, I don't know, I don't have enough confidence in the integrity of mankind to say that everybody would just voluntarily pay their share. But man, as confiscatory as the taxes have gotten and how ugly it is, how they spend my money, like funding foreign wars and, sending money down black holes to who knows where, really bothers me. But nevertheless, as a citizen, I still follow the law and I still pay it because I believe in upholding the law as best we can, I guess, but doing it to the biggest degree within the realm of what we can control, right? So I control not paying my taxes until the very last day. I don't pay personal taxes till October the following year. I don't pay business taxes till September the following year. So I pay some. I just have a little, what we call a token payment, just so they know I'm here. Right. So they know that I'm still in business, that I'm not trying to run away and hide. But yeah, I pay about 80% of my taxes late because my money can stay invested longer term. I have access to it to take advantage of opportunities. Let's say the stock market crashes 50% in March or April, and you gave all your money, all your quarterly taxes to the government. Let's say you gave $50,000 in quarterly taxes to the government, and you could have actually bought back in low in the market instead of paying that. But because you paid it, you can't say, hey, IRS, I want to borrow my money till October now. I think the market's at a low point. I think I'm going to I think it's going to bounce, and I might make 10 or 20% between now and the end of the year. Can I have my money back? No. If there's opportunities that come up like that, when the market sells off really hard, there might be a more responsible time to invest in the stock market rather than when it's overvalued like it is now. I'd like to be nimble, have my assets available. So you don't have to pay them that early. My opinion is, depending on how you're investing, would dictate whether or not you pay those in January quarterly or not.
And again, I want to emphasize that we're not here giving tax advice. You should consult your tax professional on what is the right thing to do for you. But you are right. If you do not pay that estimated tax, there's going to be a penalty, but you can wait and pay the penalty. It is totally up to you. But again, consult your tax professional. And I misspoke about the day that you have to pay your quarterly tax in January. It is January the 16th. So be advised of that. February, the same thing. Tips for January 2024 reported to the employer by February the 12th. Let's move on to, let's skip March and move on to April. April 1st, there's a tax deadline for RMDs. Is that right?
Yeah, that's true. And in fact, the reason they give you the first year you have to take your RMDs, they always give you a little bit of a break because they figure by the time you do your taxes, your CPA or H&R Block or whoever you do your taxes, your tax person, or even TurboTax is going to tell you, hey, did you take your RMD? And you go, oops, I didn't take it. So the IRS gives you a little break the first year and lets you have till basically tax time April in order to withhold those RMDs and still have it count for the withholding you should have taken the prior year. For example, if you turned 73 last year, you needed to take an RMD out. If you didn't, you're not going to get dinged. However, if you take it out this year, you still have to take another one out this year for the fact that you're 74 this year, and it's a year that you have to take an RMD. So you would be taxed on 2 this year instead of 1 last year. Now, for some people, it's actually a benefit to do that because maybe last year you sold a property or somehow we were in a higher tax bracket, you didn't want to pay extra taxes. This year with 2 RMDs, maybe you don't go into a higher tax bracket, you pay less taxes. So it might be advantageous to you to not pay early or pay on time, to actually pay the first one late, even if you had to double up the next year and pay a little extra in taxes at a lower rate, or pay taxes on extra withdrawals at a lower rate, which is in essence less total money than if you pulled your first withdrawal out last year when you had a higher tax bracket for whatever reason.
And Jeff, in the interest of time, of course, everybody knows that you have until April 15th to file your federal tax return and pay your tax due. Now, you can also get an extension on that for 6 months. It does not preclude you from paying those taxes. You will pay a penalty on that, but April 15th is the magic day this year. Well, Jeff, we're out of time for this week. I want to thank you for your time and remind everybody 520-780-9059 is our telephone number if you want to get in and sit down with Jeff and talk about your retirement roadmap. 520-780-9059. Thank you so much for listening to us. We'll talk to you again next week with another edition of Premier Retirement right here on 790 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.